she didn't notice it, I'm wearing my regular clothes.
Uh,
She wasn't still in maternity clothes, so she was pretty happy about that.
that's fantastic. Give me a moment here. I'm starting the YouTube recording. I'll be done in a second here.
Okay.
All right, that's great. All right. Okay, still there?
Yes.
Okay, good. So we're recording now, and Nita will clean it up and just go with the start of the webinar. I've got the score stump speech queued up, so I'll just run that. And
I like the way you said that.
yeah, and Chris is all queued up. She's ready to go as well. I'll just keep an eye on the chat, and you guys have done this a million times, so I'll just be behind the scenes if you need anything.
Yeah. Yeah. I don't see Chris here though.
She'll be here. She acknowledged earlier today that she'd be here.
Okay. Yeah, I've got a bit of a cold, so I have to be careful,
Uh,
but
uh,
you know,
Sorry about that. Oh, there she is. Here she
there
comes.
she is.
Yeah, Chris, you've
Hi,
got
Chris.
sunlight pouring in across your screen. You're kind of obscured there um, from the glare. You're on mute, Chris, so I don't know what you're saying.
Oh, I'm saying it. I've not had this issue. It seems like it's sunny all over the place, but
Well, obviously, your uh, laptop is turned into a solar ray collector, and okay,
okay.
you could probably call up, Cleveland Electric Power and tell them that you're prepared to put power back into the grid if they need some. Just
Isn't the nicest background. I've never had this happen. Um,
is this a background you're using?
no, it's my house. It's too cold to go outside. Should I do a background?
Maybe, yeah. Why don't you do a background?
Okay, so where do I do that?
Well, go down to uh, uh, your video over on the right, or on the
Uh-huh.
left rather, and you can say blur my background, or you can uh, choose a video filter. So why don't you try blurring your background?
Okay, so the nice thing is, most of it is going to be the screens.
Okay, yeah,
So
that's much better,
I'll
I
just
think.
be in a little
Yeah,
box, but this
okay,
is good for the
yeah,
minute.
yeah,
Okay,
that's
thank you.
fine. Okay, yeah, so
Did
we're
I
off.
mention I'm technologically not that savvy?
Okay, well, you're doing just fine.
Okay, good. How
You're
are you
doing
guys doing?
Good. I've got a bit of a cold, but other than that, all
Oh,
good.
better
you
than
got
good.
a summer into fall cold.
Yeah. It happens to me this time of year. Um, it just about 4 o'clock yesterday afternoon, I started to say, things aren't good. So went over to Target and got some medicine.
Okay. Well, I appreciate you being online, and I'm glad that you did not get sick and when you were around your granddaughter.
Oh yeah, that would have been, in that small apartment,
Yeah.
that would have been bad. So yeah, you're exactly right.
So I can do the screen share just so we're all set up.
Well, actually, I'm going to do the screen share first because I'm going to run
Oh,
this course. If you turn that off for a minute.
okay. So
Uh,
I'm gonna then forward my slides to the beginning of the deck and not do my intro slides.
oh, you have it. Do you have the score stump speech?
Yeah, yours are probably better.
No, fine. Why don't you go ahead, and then we don't have to do a handoff.
Okay,
Yeah.
so then, all right, let's see.
So yeah, that's fine. I'll turn. What I have is the latest. But if you've got the stump speech there, then by all means run it, and then you're in control all the way, and I don't have to worry about handing it off, and we don't, uh, you know.
Great.
Go. And we're all set. I will mute myself and my video once we get going. I'll keep an eye on the chat. How much time do you want to leave for Q&A?
It's funny. Sometimes, like when we did this in person, it takes so much longer because people ask questions and we go through it, I think, more thoroughly. So I think we'll probably have a good 10 plus minutes. What do
Okay.
you think, Richard?
Okay.
I agree.
Yeah. Okay. And how do you want to, if people ask, can they contact you for follow-up? How do you want to handle that?
I think the best thing is just to request a mentor to help
Okay.
people through,
All right.
not specifically. I literally just this morning put myself on pause. I don't know how I keep managing to just get in over my head. I am
Well,
set to one per week, but I'm getting one per week from the Alicia, and I'm getting one per week from direct requests. So it just builds up on me, and I'm helping our new mentor Bernie with his new incoming because I'm not the coach, but I'm one of his co people for sessions. So it's just anyway, yeah. So no direct request for me. Richard, how
Yeah,
are you doing?
yeah. I've had the same problem, but right, they're working on a way, and I don't know exactly how they're going to do it. That the uh, um, client intake coordinator can see if any direct requests have come um, in the past week. Right now, they cannot see that.
Oh, yes,
And
they
so
can. Oh, yes, they can. I
I
mean,
was told that they couldn't.
they might have to actually open up the mentors thing, but I was on CAT for a long time, and they can see what's open, what's pending. They can
Yeah.
see if sessions have been had. They know the dates they can see all that.
So
Yeah.
they're just not paying attention to it.
Right. They're also reassigning to new mentors requests that are coming in, any amount of time. So Dan, that's how we got what's his name that we just
oh, Dylan.
Dylan.
Yeah.
3 mentors got assigned to Dylan within a 1 month period. Because he kept putting in requests. He wanted financial help. He wanted marketing help. He wanted blah, blah, blah. So he kept getting assigned, and it says existing. And that's the first thing you look at. Is there an existing case file on this client? And you bump it back to the last known mentor. And I've talked to Morgan, is that her name, who's in charge of it, many times, and they're working on it. So
Yeah,
they know about it.
yeah. What I do, for what it's worth, is every 90 days I put myself on pause for new clients for a month.
Okay.
And I give myself a break.
Yeah.
And I turn off direct requests as well. So I've done that for the month of October. I'll do it again in January. And it's nice, to have, to do that. It creates kind of a cadence. We're busy for 3 months, and then I'm going to be off for a month. And I still have existing clients, but at least I'm not head over heels with new ones.
Yeah. Yeah.
Right.
I put myself on pause as of the 29th of September through this coming Friday. And part of that was because I knew sometime we were going to New York to help our daughter. And the other part was because of the Jewish holidays.
Right.
So, I don't like taking new clients between Rosh Hashanah and Yom Kippur if I can avoid it. So, but as of Monday, I guess I'm cannon fodder again. So,
Yeah.
Well,
Chris, let me interrupt. We got one more minute. Do you want to launch I'll launch the webinar. Do you want to go right to the introduction? I'll just go on mute at that point.
Do it, Chris.
Welcome everybody.
You want to start with this?
Yeah.
Yeah.
Okay.
We've got one more minute. We have 20 online so far. I'm expecting a fairly good crowd because this was promoted regionally. But hard to tell. It takes about 10 minutes for people to come in, and you get all these requests. Are we going to get the slides? And I will answer those in the chat as they come in.
Great. How many people do we have on?
Right now, we've got 20, and there'll be more coming in. We got one more minute, and of course, Some people might be in their own time zone. They'll get in at 5 after or whatever. But we'll see how that goes. But Engage records the number of attendees who actually come in, and Gwen has the numbers at the end of the day. We're at 24, so the count is still going.
Great.
All right. And I might step away for a minute once you guys are rolling, but I'll be back, in a minute or two afterwards. So not to worry.
Perfect.
All right, we're at 12. I'm going to start the webinar, and you're off to the races, Chris.
Thank you. Oh, you're doing the intro? What, Richard,
Either one of you.
Richard, would you do the intro slides? Oh, I think you're on mute.
Try again. Welcome, everybody, to our webinar on financial management, the basics. Chris Analazar and I will be hosting this and leading you through some of the basics that everybody should understand for good financial management. But first, we want to talk a little bit about SCORE. SCORE is the organization that we are volunteers of. Everybody in SCORE is a volunteer. We are a nonprofit organization dedicated to helping small businesses get off the ground, grow and achieve their goals through mentoring and education. We've been doing this for about 50 years. SCORE was actually founded in 1964. So it's actually closer to 60 years. Next slide, please. Our services include a free face-to-face or virtual mentoring. We do a lot of it through email, telephone, and video. Our workshops and seminars, we're doing this workshop today, so you're aware of those things. For startups, business planning, marketing, just about any phase of business that you need help with, we can help you with. We can also do customized webinars for community partners, and we will do boards of advisors. We don't do boards of directors because those are compensatory. People, normally get paid for that. We are a volunteer organization. We don't do that. All of our work is free. We get a portion of our funding from the U.S. Congress, and then we have contributors to SCORE in addition to that, and all of our services are provided to you at no charge. And this particular session is being presented by the SCORE Cleveland chapter. The SCORE Cleveland chapter is an exceptional chapter within SCORE. We were the 2022 National Chapter of the Year. We're the 2024 Ohio District Chapter of the Year. And we've got about 100 volunteers in our chapter. And not only, the Cleveland chapter, but there are chapters all over Ohio and Indiana and Michigan, and wherever you happen to be, there's a SCORE chapter to help you nearby. And so what we're going to talk about today is how to make more money in your business. I want to introduce at this point Chris Analazar. Chris is one of our volunteers. She's also a former business owner. She started her business from scratch. She tells us literally at her dining room table. And she ran the business for 19 years. She was very successful. And she is one of our better SCORE volunteers in the Cleveland chapter. And so I'm going to turn it over at this point to Chris.
Thank you, Richard. Welcome, everyone. Today, we are going to talk about your finances in your business. We're going to start very slowly, just so that we're all on the same page in terms of terminology. We're going to cover basic financial vocabulary. We're going to look into how to calculate profitability for your business. We're going to have models that hopefully you can use those models to apply to your own business. We're also going to, once we know profitability, we can calculate what's called a break-even point, and I'll explain exactly what that is. We're going to then look into different types of accounting, financial statements, and financial service providers. So we've got a lot to cover. We're really going to start with how do we track money coming into your business and money going out of your business. So just so we know the terminology, all the money that comes into your business is generally referred to as revenue. The money that goes out of your business are your expenses. And if we subtract all of your expenses from your revenue, that's what's left over is your profit. Now, you might have positive profit, meaning you're making money, and you might be negative, meaning you're losing money. So sales is generally your revenue, and your costs are your expenses. That's the money going out of your business. So those are really the only two movements of money. Money's coming in, money's going out. So if we can really track this, all the money coming in and all the money coming out, this will lead to you making better business decisions because you understand how and where your money's going. So expenses, we're going to start with just looking at expenses, and there's two categories of expenses, and these are important for each of you that have a business. You really want to take some time to either yourself or work with your accountant or get a SCORE mentor. If you don't have a SCORE mentor, you can request one and they can help you look at this. So one category is called your fixed expenses, and the other category is called your variable expenses. Your fixed expenses stay the same regardless of your sales. So you could sell $10,000 of a product in a month or $2, and your fixed expenses stay the same regardless of what your sales are. Your variable expenses are directly related to what you're selling. So as your sales go up, your variable expenses go up. As your sales go down, your variable expenses go down. So let's look at some examples. Fixed expenses are things like your rent. Your rent is the same, doesn't matter. They're going to still want their full amount, even if you don't have clients or sell product. Utilities, an auto loan, your insurance policies, loans that you have to pay for equipment that you may have purchased, and things like salaries. Those are going to be your fixed expenses. You know they're coming and they're the same, give or take. I mean, I know utilities go up and down a little bit. In general, they're the same every month. Your variable expenses are things like commissions, marketing, your raw materials if you make product, and shipping charges if you sell and ship product, and any direct labor that's related to a service or production. Now, something like an office manager is not direct labor. That would be a salary, but someone who's making actual pies, let's say, that would be direct labor. So we're going to look up a fictitious company called Puzzle Mania, and we're going to look at what is their profitability. So first, we're going to look at their fixed expenses. Again, these are the things that don't change month to month. They've got rent of $3,000, a telephone bill, insurance, salaries, internet service, and utilities. So all combined, their monthly overhead expenses that are fixed and not changing is $9,070. Fixed expenses are expressed as a dollar. It's a flat amount that doesn't change. Because your variable expenses change based on volume, they're shown as a percentage. and we'll see how this works out later. But basically, Puzzle Mania makes puzzles, and their raw materials, which include chipboard and adhesive and boxes for packaging and all of their materials to actually make their product, is 15%. Their wages to make the product, all the direct labor related to making puzzles, is 20%. Processing credit card fees when they sell them is 3%. Their shipping is 3%, and they pay 8% for marketing. So if we add all that up, their variable expenses are 49%. So now we're going to look at how do we calculate profitability. So Puzzle Mania sold 1,500 puzzles at $20 per puzzle in the month of October. So if we multiply 1,500 puzzles times $20, they brought in $30,000 in revenue for the month of October. So we're going to take that $30,000 and we're going to multiply it by 0.49. That's going to tell us what our variable expense is. So our variable expense, 0.49 of 30,000, comes to $14,700. And we know their fixed expenses are $9,070. So like I said on the previous slide, if you subtract all of your expenses from your revenue, that shows you what profit is. So we're going to subtract the variable expense, subtract the fixed expense. We're left with $6,230 of profit. And if we divide that into our revenue of 30,000, that tells us we have a profit margin of 21%. Now, this is really important, this little green bubble in here, especially for businesses that are in their first year of business. Always, always keep in mind that profits that you have from your business, part of that is going to go to Uncle Sam for taxes. So it is not uncommon that first year people in business, they make whatever money they make and they think, okay, this is my money because I made it. And while that's partially true, it's also true that you want to reserve some of that money to be able to pay your taxes. After your first year, assuming you had profits, and your accountant will help you calculate this, you generally have to pay quarterly estimates on your profit based on last year's profit. So after your first year, this smooths out and you pay quarterly estimates, but the first year can be tricky and you really want to stay on top of putting some money aside for that. Okay, now we're going to talk about something now that we've calculated Puzzle Mania's profit margin. We're going to look at something called break-even point. This is really, really important. Your break-even point is the amount of sales that you need to bring in to pay all of your expenses. And it's exactly what it sounds like. You're just breaking even. You're not making money and you're not losing money. And the reason this is so important is because the real profit for your business comes in after you've met your break-even point. And to the degree that you can keep your variable expenses low, that's where your real profits come in. So we're going to look at some examples of this. So to calculate your break-even point, we're going to take all of your fixed costs, those are the things that don't change, and we're going to divide it by something called a contribution margin. Your contribution margin is your unit price, whatever you're selling, minus your variable cost per unit. So again, that's going to be a percentage to calculate that. We divide your fixed cost by your contribution margin, and that tells us how many units we have to sell to break even. So now we're going to go back to Puzzle Mania so we can calculate this. We already know that their fixed costs are $9,070. We know their variable expenses are 49%. So we're going to take $9,070 and we're going to divide it by the contribution margin. So in this case, we know our unit price is $20 per puzzle. If we multiply $20 by 0.49, that's 0.49%, it tells us that the variable cost is $9.80. When we subtract $9.80 from $20, it gives us $10.20. That's our contribution margin. So we take $9,070, we divide that by $10.20, and we see that that equals 889 puzzles. If we multiply 889 puzzles times $20, it tells us that our break-even point is $17,780. So now we know that if we sell 889 puzzles, we've covered all of our costs. If we sell more than 889 puzzles, we're going to be making a profit. And if we sell less than 889, we're going to be losing money that month. So we looked at a company that was making a product. Now we're going to look at a service company that sells a service, not a product. So we're going to look at another fictitious company, Lulu's Beauty Salon. Lulu has a lot of overhead. She's got expensive rent of $4,600 a month, her telephone bills, her insurance. She has one manager. She has internet, IT, website is a lot because she does a lot of the booking and all this stuff online. So there's a steep expense to that. And her utilities and electric is also fairly high because of the business that she has. So her fixed expenses are $11,420 a month. She also has sort of high variable expenses. Her biggest expense you can see sticking out is her commissions, is how she pays her hairstylist. 45% of everything that comes in goes to the stylists that are providing their services. But she's got shampoo and conditioner for 2%. Her hair dye and perm kits are 7%. Commissions, like I said, 45%. Her credit card fees are a little bit less, 2%, and her marketing is 4%. So her total variable expenses every month are 60%. So Lulu serviced 18 clients a day, 6 days a week. She's closed 1 day a week. So if we multiply 18 clients a day times 6 days a week, is 108 services per week. In a given month, there are 4.3 weeks in the month. So we then know if we multiply 18 times 6 services per 6 days per week times 4.3 weeks in the month, and her average service is $120. Some are more, some are less, but that is her average. She is looking at revenue of $55,728, which is great. She's very, very busy. Everyone is packed. She's got a fabulous business going. So now we're going to calculate her variable expense, same as we did before. We're going to multiply 55,728 times 0.6. That's going to tell us what 60% of that revenue is. So in her case, it comes out to $33,437. That's 60% of her revenue. And then we're also going to subtract out her fixed expenses. So she brought in $55,728, And after all of her expenses were paid, she's left with $10,871 of profit. If we divide that by her total revenue of $55,728, we see she has a 20% profit margin. So again, a very healthy profit margin. She's got a nice business going. She's busy and they're making a lot of money, and she's paying her stylist well. Now we want to look at what's her break-even point. What is the amount she needs to sell to cover all of her costs? So we know her fixed expenses, $11,420, and we know her variable expenses are 60%. So we take her fixed expenses, and now we need to figure out her contribution margin is her average price of $120 is the average service price. We multiply that by 0.6 to come up with $72. And the difference is 48. So 120 minus 72 is $48. We're going to take 11,420, that's her fixed cost, and divide it by $48. That tells us that she's going to need 238 clients per month to cover all of her expenses. If we multiply 238 clients by her average service cost of $120, we see that $28,560 is her break-even point. And again, if she sells more, if she has more clients, she's going to be profitable. And if she has less clients, she's going to be at a loss. We're now going to look at one more example. This is going to be Walter's window washing company. So Walter has very low fixed expenses. It's just him. He's got a truck lease, his insurance, his liability insurance, his health insurance, a cell phone, and a pretty basic website. His fixed expenses are $2,600. His variable expenses are also pretty low. His gas is his biggest expense at 10%, cleaner 4%, rags 3%, credit card fees 3%, and 4% for marketing. So his total variable expenses are 24%. Hopefully by now, each of you who has a business, I hope that you are starting to think about your own expenses and which of your expenses fall into the fixed expense category, which fall into the variable expense category. It may seem a little bit confusing. How do you come to these percentages when you're talking about variable expenses? And again, this is something that you can work with a mentor on, but the general gist is if you look at your expenses over a longer period of time, like let's say 3 months, 6 months, or even a year, and you divide up all of your gas, you can have an idea of how much you're spending. You also might have accounting software, like even QuickBooks, that will tell you some of these things, that it'll calculate what percentage is going to each of these different categories. So there's many ways to get these numbers, but again, this is really, really helpful in doing planning that we're going to talk about a little bit later. So Walter services 2 clients a day, 4 days a week. The reason he only works 4 days a week is we live in Cleveland. We don't necessarily have the greatest, clearest weather. No one wants their windows washed in the rain or inclement weather. So he's got a limited amount of time that he can get this done. So if he has 2 clients a day and he works 4 days a week, and there's 4.3 weeks in the month, we know his average service cost is $300. Walter is bringing in $10,320 a month. So we're going to take 10,320. We're going to multiply it by 0.24. That's how we calculate 24% of his revenue. So we know his variable expenses, 24% is $2,477. So we're going to subtract all of his variable and fixed expenses. That leaves him with a profit of $5,243. If we divide that into his total revenue of 10,320, his profit margin is 51%. So many of you might be thinking, wow, I'm going to start a window washing company. So one of the things to think about, Walter has very low expenses and a very healthy profit margin, but he's a seasonal working business. So this is where we're going to talk about things like cash flow a little bit later. His model of business is fabulous in the summertime when the weather's nice, but not so good in the wintertime. All of this, using these numbers and understanding his fixed and variable expenses, will help him with cash flow and plan for the future, because he owes his truck lease in June just the same as he owes his truck lease in January, but he's got no revenue in January for window washing. So we'll address that a little later, but something to think about. So we're going to do the same thing again. Walter's break-even point, we look at his fixed expenses, 2,600, his variable expenses, 24%. We're going to take his fixed costs and divide it by his contribution margin. So in his case, his average price per unit is 300. We're going to multiply 300 by 0.24. That'll give us 24%, which is $72. If we subtract $72 from 300, the contribution margin is $228. So we're going to take $2,600, his fixed costs, and divide it by $228. That tells us that he needs 12 clients per month to break even and pay for all of his expenses. So we take 12 clients times his average cost or fee is $300. He needs to bring in $3,600 to cover his costs. Now, again, this is a little bit misleading because he's got to bring in enough money to cover all of his expenses, even in the winter time. And that we're going to address when we look at things like your cash flow. So we're going to look at money coming in and money going out each month and how you can prepare for something like this. If he does more than 12 clients per month, he's going to be profitable. And if he has less than 12 clients per month, he's going to be losing money. So you might be thinking, how do I get all this information? One of the easiest ways is if you have accounting software, but it is not necessary to have accounting software to get this information. You can also collect it by looking at all of your revenue coming in. To collect this kind of information, you want to look at the deposit section of your bank statements, any point of sale systems you're using, paper receipts, Square, and any software related to bringing money into your business. On the expense side, you're going to look at the debit section of your bank statement, any checks that are in your checkbook, paper invoices, vendor account histories, credit card bills, employee payroll, and any contractor 1099s that you pay. So one thing, if you don't have great bookkeeping habits, you can contact your vendors many of them, and ask them to give you a report. You can say, can I get a year-to-date report of all of my purchases? Or you can say, can I get a report from 2023 of all of my purchases? So you can absolutely collect this information. It's much more time consuming than accounting software, but is totally doable. And with that, I am going to pass the mic on to Richard.
Thanks, Chris. We're going to get into some of the more details that Chris was talking about. And the first thing that we're going to discuss is there are two types of accounting. Financial accounting records your past transactions. There are strict formats and conventions for that because taxes are due based off of that, and there are other issues related to how sales and expenses are recorded. They have to be able to withstand an audit. If you tell the government, for example, 5 years in a row that you haven't made any money, they are likely to come in and start asking questions. So you need to have good documentation on financial accounting. And this is usually done for you by either a bookkeeper or an accountant or another person who has solid financial background. Financial accounting basically, as the first bullet point shows, looks at the past and records what you have already done. Managerial accounting looks to the future. And so through managerial accounting, you forecast future performance. It's easier than recording the data in financial accounting, but it has to be consistent with the financial data that you already have. It must be realistic, and it's usually done by you with the support of either your in-house accountant or your bookkeeper or whoever you hire to do this from the outside. And the difference here is that you use your history to project your future. For example, if you have a business loan, your lender is going to want to see your books at the end of the year and then your forecast for the following year. So you will use your financial accounting to record what you did in the past year and then use that as a tool to your foundation for forecasting your business in the future. And starting out with a new business, you obviously don't have a history. So you're going to be able to gather certain costs that you're going to need. It'll be easy for you, for example, to forecast what is your website going to cost, what is your point of sale system going to cost, all these kinds of things. If you have a lease or a loan on your car or your truck, if you have a business loan, you'll be able to forecast that. And then you'll have to do your best guess at your sales based on what you think you ought to be able to do. And if you're working with a SCORE volunteer, we can go through that process with you and help you determine what is realistic. I will tell you that for businesses just starting out, I always recommend 3 different sales models. Worst case situation, best case situation, and something in between. And normally it's the something in between that we turn into the lender to qualify for a loan. The worst case you have in your back pocket, that's your contingency plan in case the floor falls out. And the best case is again in your back pocket, in case things just go absolutely bananas. I have a client who we did that exercise with, and to give you an example of why we needed to do that, she started out in 625 square feet of space, thought that that would be sufficient for 2 years. She started in October of last year, and she's already in 1,800 square feet of space because her business has really taken off. So we had a plan for that business in case the business really took off. Next one. Okay, what does each type of accounting do for you? Financial accounting produces information primarily for others. It's produced by accountants, bookkeepers, and your accounting software. It provides valuable history to yourself and any stakeholders. Remember, a lender is a stakeholder. If you have investors in your business, they are stakeholders. In certain cases, vendors to you may be stakeholders. So it provides valuable information about the health of your business. Managerial accounting provides information for you so that you can build a financial model for your company. Very important. Forecasts start out rough, but get better with experience. Again, they start out rough because you don't really know what they are, and you can use spreadsheets, graphs, or just plain paper forecasts. A lot of people, it's easier for them to understand things through graphs or spreadsheets. Other people just write it out. Today, we're going to focus mostly on managerial accounting. Just as a side note, most businesses lose money in the first couple months because they're just building their client base, their customer base, and it takes a while to get traction. I will tell you that I come from the hospitality industry. I've opened over 20 businesses in my career, and most of those businesses did not make money in the first year because of various things going on in the nature of the hospitality industry. But I will tell you that we prepared our lenders in advance. They understood it. And as long as we were on track to make a profit, that they could see farther down the road, they were fine with it. Most businesses don't make money in the first several months. Don't panic over that if your financial forecast shows that that's the case. Okay, let's talk about some basic financial statements. Accountants and software like QuickBooks, FreshBooks, Peachtree produce 3 standard statements for you, and then you can customize other statements. One is the profit and loss statement. It's often called an income statement. The second one is a cash flow statement. Chris alluded to that in her presentation. And finally, the balance sheet. We're not going to really get into a balance sheet today. It's a snapshot of the health of your business at any given time. It's not a dynamic kind of a thing. It's a snapshot. Balance sheets show 3 basic things: your company assets, your company liabilities, and the difference between your assets and your liabilities is your net worth in the business. It's called the owner's equity. And so we're not going to really get into that in detail. We're going to focus more on profit and loss and cash flow today. These statements help you prepare your taxes, especially the profit and loss statement, produce information that potential lenders or investors request. Again, lenders are going to request a profit and loss and a cash flow statement from you every year at the end of the year, or whenever there's a renewal of your loan, and help you predict the future for your business by creating a financial model. Again, that's the financial accounting side, to be able to help you forecast on the managerial accounting side, and it helps you gauge the health of your business. Next. Okay, let's talk about the profit and loss, again, sometimes called the income statement. It uses data on revenue and cost to determine current profitability. Okay, that's the financial accounting side. It'll show you how profitable your business is likely to be over time, and that's the managerial accounting side. It helps you prepare your taxes, and it demonstrates to potential stakeholders that you have a realistic path not only to gain profitability, but to sustain profitability. And it helps you pinpoint excessive costs or unprofitable product lines. Next. The cash flow statements show potential lenders or investors that you have a realistic view of your cash flow. And what cash flow is it looks at the revenue that you take in, and then it looks at the expenses that you're paying out. And whatever the difference is between the two, that's your cash flow. If you're spending more than you're taking in any given month, you have a negative cash flow. If you're taking in, your sales are more than your expenses, you have a positive cash flow. And that's really important because on paper, you can have a net loss on your income statement and still be having a positive cash flow. And I know that sounds confusing, but there are a lot of details involved in this. And again, your accountant or your SCORE volunteer can help you understand what the difference is between the two. The two statements are similar, but they're not the same. Okay. Going forward with this, cash flow statements help you predict and prepare for cash shortages. And that's where Chris was really going with this during her presentation. You can forecast when you are going to need help with cash. Your business may be seasonal. For example, you may have an ice cream truck, and you're going to make a lot of money in May, June, July, August, and September. And the rest of the year, you're not going to be making a lot of money, but you still have expenses to pay, as Chris was mentioning in the window washing company that we referred to. And so you have to plan on making enough money during your peak season so that you can still pay your expenses and yourself during the off season. And so that's what the cash flow statement is all about. Cash flow crunches can sink a business faster than a lack of profitability. Okay, if you're out of money and you have to go back to your lender and say, I need more money, they may not be happy about that. It allows you to identify and plan for seasonal fluctuations in sales. And a cash flow model can enable you to view what your checkbook will look like in the months ahead. It will help you plan when you can make major purchases if you need to do that, and enables you to predict how large a cash reserve you will need. Next. Okay, let's talk about financial service providers. There are bookkeepers, and normally a bookkeeper would have an associate's degree or higher. And all they do is record financial transactions for you. You may not have the time or the skill set to actually work with either just a spreadsheet or your financial software. And so the bookkeeper, you can hire that person to do the data entry for you, but they do not do data analysis, and that's important. An accountant normally has a Bachelor of Arts or maybe a Bachelor of Science in accounting, or maybe higher. They can help you interpret your financial information, and they can give you advice. When I first started out with SCORE, several of my clients had accountants. They had existing businesses, and all the accountants were doing was producing the financial statements and helping them file their taxes. That's all they were doing. In fact, a bookkeeper can help you with that. And they were not providing the financial advice and giving the interpretation of the financial statements that the clients needed. And basically what I told them was either tell your accountant, this is what you need in addition to them filing your taxes, or you need to go find another accountant. Your accountant needs to be one of your stakeholders, one of your partners that's going to help you. A CPA is an accountant who has passed a series of examinations and is a certified accountant, and they are licensed by the state. So they are one step above a regular accountant. Next. Okay, projections and ongoing accounting. Projections aren't just a one-off, one-time effort. They need to be ongoing. I will tell you that in the work that I did in the hospitality industry, we would update our financial projections every month for the coming months. As a matter of fact, we did it for 3 months, and we did a rolling 3-month projection. That was really important because there could be significant fluctuations. The situation in Florida is a really good example of that right now. Nobody saw this coming several weeks ago, what happened here with Hurricane Milton and Hurricane Helene before that. And so a rolling 3-month forecast for the businesses, not only the hotels and the restaurants, and the general hospitality environment in Florida, but other businesses as well, the shops, all the other businesses that probably are not going to be back for a while. That rolling 3-month forecast is going to help them, especially if they have outstanding loans, because they can then go back to their lenders and negotiate with them for some form of abatement to help them while they get back on their feet. There should be a continuity between your financial projections and the ongoing tracking of your finances. Don't just pull numbers out of thin air and say, this is what we're going to do. Your financial projections need to be based on financial accounting, your history, and then your best estimate going forward. If you use an accountant, show him or her your projections to assure consistency. They can tell you where things are off. And if you're using accounting software, compare its financial reports to your projections and contact customer service to understand the differences if there's anything that you don't understand. Okay, collaborating with your accountant. This is very, very important. Again, they need to be one of your stakeholders, one of your partners in your business. Jointly work on your chart of accounts. Every trade association in the country has a standard chart of accounts. Your lenders know this already. Your accounting, whether it's just spreadsheets or you're using financial software, need to conform to that chart of accounts. And the reason why is, give you an example. Let's say that your labor cost is 25% of sales, your direct labor cost. And that's the people actually working on creating your products or your services, which results in your sales. And let's say that you don't account for that properly through the chart of accounts of your industry. A lender may look at this and say, well, wait a minute, the industry standard is 20%. Why are you showing 25%? Or the industry standard is showing 40% and you're only showing 25%. So you need to be careful about this and understand the chart of accounts. Your accountant can help you with that. It's all public domain information. And by the way, just as a side note, you do want to join your trade association whenever practical. They provide training, they provide great information, they provide networking opportunities, they provide your chart of accounts. It's really well worthwhile. In addition, regularly review financial statements and reports with your accountant for trends and anomalies. If results are unexpected, drill down to find out why. If sales were off, what was the problem? Was it the weather? Was it new competition? what was going on. If your expenses are higher than expected, drill down, find out why. I will tell you that when I got my financial statements every month when I was working in the hospitality industry, I would focus on that and really look in detail. This is what I thought I was going to do. This is what we did do. What's the difference and why? And you use the data to identify the most profitable product lines or services, identify the least profitable product lines and services, identify what customer segments are really most profitable for you and least profitable for you, and diagnose potential problems. You know, you may be looking at a customer segment, for example, that looks great because you have such a high sales volume, but it may cost you the most to really focus on that as well. So your profitability in that, even though your sales are high, your profitability could be low. And we're actually going to look at a couple of those in a future session. Chris? Okay. And finally, here's a general sales glossary. Again, everybody's going to get a copy of this presentation. And so here are a general sales or a general glossary of the terminology that we use today. Chris?
Excellent. Thank you so much. So I think we have a little bit of time, about 10 minutes, to open it up with some questions. Dan, did you look at any?
Yeah, I've been answering the questions in the
Oh,
chat
okay.
for the
Okay.
most part.
Oh, gotcha.
And there's a number of questions that probably should be directed to a session with a mentor. Here's one you could probably come back. Could you explain contribution margin in simple terms?
Yeah, so the contribution margin is just your average sales price minus your variable expense. So everything is done in steps and stages, and you can't figure out your contribution margin until you know your average price of goods and you've calculated both your fixed and variable expenses, so you have those percentages. But once you have that, anything that's directly related to the product you're selling or the service you're selling is giving you that contribution margin. And then whatever that is, big or small, is divided into your fixed expenses to figure out your break even. And again, if you think about covering all your costs, the reason this is so important is it helps you set goals that if you know what your break-even point is, you have to exceed those goals. That's where all of your profit is. To the degree that you can get beyond your break-even point, you're just gonna, that's where all the profit comes in. Otherwise, you're just basically working to pay off your expenses until you've gotten to that point. I'm not sure if that was more clear or the same.
I just want to remind everyone, you will get a copy of the slides and also a link to the recording of this. Richard?
Let me just add to that. I think Chris gave a really good explanation, but let me give you an example of your variable costs. Your variable costs are normally the raw materials that you need. Let's say you're selling ice cream. For some reason, I like ice cream. I don't know why. And you're buying ice cream from an ice cream wholesaler, and an average 5-gallon drum is costing you, let's say, $20. And you know that on average, a scoop of ice cream that you sell is costing you, let's say, $1. And you're selling it for $3.50. So your raw material is the ice cream and the ice cream cone or the cup that it goes in, maybe the spoon that goes with it, maybe a napkin and all that. That is part of your variable cost. Now, if you're doing this yourself, then you can attribute whatever you're paying yourself. What does it cost me to actually make up one ice cream cone? Well, I'm paying myself, $25 an hour, and it takes me 3 minutes to make up an ice cream cone. Therefore, I can figure out by 3 minutes divided by $25 an hour. My labor is 15 cents or 20 cents or whatever. You throw that in there. If you're paying other people to do the work, let's say that you're selling ice cream, but you have somebody out on an ice cream truck for you and you're paying them $25 an hour, that is a direct cost to your sales. If you're sitting back in your office trying to build your business, working on marketing or something like that, then you are part of a fixed cost of sales because you're paying somebody else to do the work. So generally, your raw materials, your ingredients, whatever you're selling or the services that you're providing, and the direct labor involved in that is the sum total of your variable cost.
It looks like
And
there was a question about pursuing financing.
I've been running my business for almost 5 years. Cash flow is solid, and I've been able to get this far without pursuing financing. Is there any reason to look for a business line of credit, or is something like that just insurance?
Yes, I'll jump in. Absolutely, yes. As they say, when you need money, it's hard to get. When you don't need money, it's easier to get. So absolutely, if you have a profitable business, it's always a nice idea as a backup insurance plan, open a line of credit. And then you can work with your accountant. There are absolutely times where it is a good idea to finance things. So for me in my business, it grew very, very quickly. And I had exploding receivables that I was waiting to collect on. So this is money that other businesses owed me. And the type of accounting that we did, I had to pay taxes on those sales that were in receivables, even though I didn't collect the money. So after a few years of exploding receivables, it was in our best interest to take financing. I bought equipment and I accelerated the depreciation. So I was able to write off a large expense that offset the income of those receivables. So my tax implications were managed much better. So that was a strategic decision based on that, my business and how it was structured. So there's so many variables if you're cash accounting or accrual accounting, and I don't know, is not as many businesses have receivables as they used to, but there's many variables, and those are the types of things that your accountant, if you're using an accountant who is managerial and helping you, these are the exact kinds of questions you ask them, and they can help with that.
Just to add to that, Chris is absolutely spot on with that. You notice that we had an example of Puzzle Mania. Well, Puzzle Mania's peak seasons are November and December because it's Christmas. And they may also have some other variations during the year. Their slowest time is going to be June, July, and August. People are outside playing, they're on vacation, blah, blah, blah. They're not selling. But that's when they need to buy their inventory to make their fiberboard to make the puzzles so that they have the puzzles on the store shelves in October, November, and December. So they need cash in June, July, and August. And so they need to plan for that. A business line of credit could help them with it. In most cases, you will not be charged for a business line of credit unless you draw on that business line of credit. So it's not really costing you. The bank or the lending institution may charge you something, a small amount just to set up the account, but you're really not charged anything until you draw on that.
One last question. It's almost at the top of the hour, so we have time for one more question. Can you suggest any non-cloud-based accounting software for starting a small business. In other words, they have a small business getting started. They don't want to be in the cloud. They want something local on their PC. Do you have any recommendations for consideration? Keeping in mind, of course, we don't endorse any recommendations, but maybe you could list some that you know about.
I think that QuickBooks used to have had non-cloud based applications. I'm not sure if that still exists. One thing, depending on the kind of business that you have, I don't know that I would suggest it, but you could do very old school ledger style where you set up some spreadsheets through just Excel or even Google Docs, Google Sheets can set up things that you can start to record. Again, I think a lot of that is going to have to do with the number of transactions that you have in a given month. So if you have something that is fairly simple to track, absolutely a spreadsheet or good old pen and paper can work for you. Those are not, they're not used as much. Well, that was the only thing that was used. It is more time consuming in the long run, but depending again on how many transactions you have and how complicated, it can be very, very useful and functional.
Okay, we're going to wrap it up here and thank everybody for their comments and their questions. Everyone will receive in a few days. Give us some time because we have to send this out by the postal service, and that, of course, is a variable. But you will get this a link to the slides and also to the presentation recording. You can view the recordings many times as you want. The slides are yours for your personal use. And I want to thank our presenters for a really great presentation and wish you a good day. We're now ending the webinar.